Do Money Differently podcast is brought to you by Acorns. I've been using Acorns for several years now, and here's why. It's ridiculously easy. Imagine every time you pay for a latte or hit up a drive-thru, and your spare change is silently working in the background, turning your pocket change into ownership of great stocks of the companies you likely do business with every single day. There's zero hassle. It feels like magic as you are now investing on autopilot. Be sure to click the link in the description below in this episode so you can get a $40 bonus when you open an account. You'll be so happy you started your investing journey with Acorn. Welcome to Do Money Differently. We are very excited to have Dan Sutton, CEO of Kemba Credit Union, on. Dan, thanks for being on the Do Money Differently podcast. My company, just as a quick introduction before I want to hear about you and your background. You and I have known each other for a few years now. My company, Young Money University, and Kemba have a wonderful partnership together, helping younger people understand money better and certainly begin doing money differently. So again, welcome to the podcast, Dan Sutton.
Thanks, Todd. Really appreciate the invitation.
Awesome. Okay, so I want to learn a little bit about you even more than I know. And I know our listeners and viewers too, before we get into that fun icebreaker of what was your dumbest money move and what was your best money move when you were young. But give us a little bit of color, some background. You don't just become CEO of Kemba Credit Union after a year working at the credit union. So give us some color, where you grew up. And I also saw there's been other O's behind your name the last several years too. You've been a CFO, a COO, Chief Operating Officer. So give us some background of how you got to where you are now.
All right. Do you want my money moves now or after?
All right. We can start with that. Let's do that. What's your dumbest money move that you've made, even as recent as this morning or way back when you were younger?
Okay, awesome. Well, there's probably a laundry list of dumb money moves that I've made in my life. I just had an opportunity to share with a local university class, earlier this week, and I confessed to them too my dumb money move, and it was dumb because I was uneducated. And but anyway, what I did was when I was in college at 19 years old, I decided I'd move out of the dorms and go live in an apartment down the street. A little bit more independence. It was also cheaper, to be honest. But when I made that decision, I didn't have any furniture. I didn't have a couch. I didn't have a TV. I didn't have a lamp. And but my student loans or my financial aid, I had an extra $4,000 that I did not need, but they had given me or approved me or whatever. So of course, I borrowed everything that they offered me, and I took the extra $4,000 after paying off my tuition that year and my books, and I went to the local furniture store down the street and bought a couch, an entertainment center, a TV, lamps. I had the most tricked out, the nicest off-campus apartment than anybody that I hung around with. And Todd, to be honest with you, it took me 18 years to pay my student loans off. And that $4,000 that I used, that newfound money that because $4,000 to me back then was like $40,000 to me now. I thought I struck gold with that. And, but it took me a long time. It took me almost 2 decades to pay that $4,000 off. So that was probably one that comes to mind right away. A successful money move that I have, I would say, would be getting myself out of debt. And I did that. My wife and I, when my wife became a stay-home mom, we used a lot of credit card debt to actually truly, honestly finance her at that time to be a stay-home mom. So we literally financed her with credit cards or a second mortgage. But the problem with that financing is I ran up credit card debt at that time at a young age. And the way I got myself out of that was the debt snowball type of approach, where I just attacked the smallest balance, and then I took that money and paid down the next one and paid down the next one. And so that to me was I was able to experience small wins, which kept the wind behind my sails and kept me moving. And before long, no time, I was completely out of credit card debt. So that was a long time ago, though. We're talking like 30 years ago, 35 years ago when I made that stupid $4,000 decision, probably 30 years ago when I, got myself out of credit card debt. But those are just a little bit of things that come to mind when you ask me that question, Todd.
Yeah. Oh, we all have them. Like I agree with you. I have a laundry list as well. I've shared many times when I was in my sales job after college and I knocked on someone. I was selling long distance sales and I knocked on a small business in Cincinnati. And the company's name was National Sorbents. I'll never forget it. They said, "Hey, you look pretty professional, and you look, I don't know, basically you look like a smart guy." I'm like, oh, whatever that means. And we're a private company, but we're going public soon, and we're offering shares to invest in our company. Here's a brochure. And I'm like, what's going on here? And next thing I know, yeah, we're looking to go public, and our stock is trading at, right now at pennies. It's because that's what. And hey, do you want to come to our meeting tonight? We're actually talking to potential investors, and I end up showing up. I give them 1,500. I write a check for $1,500 to a company I just met 24 hours ago,
Okay.
and I never saw that money
Yeah, I bet you
return. It
didn't.
never, no, it didn't. So, been there, done that, sir.
Yeah.
All right. So
All right.
you and I, we do have a common passion in helping young people learn about money, helping. Obviously, you were with a credit union, helping young people learn the difference between a credit union and bank, and that is not going away. That education is not going away. So I would love for you to get out of the gate, just to hear our listeners and viewers to hear straight from you. What is that difference between a credit union and a bank? And I know you've answered this question millions of times, but it is still, I just got it yesterday in a presentation here in Cincinnati, right? It's not going away. So again, it's a very popular, common question. I'd love to hear what your rendition is to that question, the difference between a credit union and a bank.
Okay. Yeah. I am not here to throw mud at banks or slam banks or insult banks. Banks have a very important purpose in our economy. They do great things. Likewise, so do credit unions. Credit unions do great things. What's different about credit unions and banks? It's fundamental differences. So a credit union is a not-for-profit. We are a financial co-op. So credit unions are 501c14s, not for profit. That does not mean credit unions are not profitable. What that means is the profit that a credit union generates is different where that profit goes. So a bank may send its profit to Wall Street for investors or shareholders, stockholders, where a credit union's profit goes right back to the members who own it. And that's also fundamental different. Credit unions do not have customers like banks do. Credit unions have members because the members own the credit union. And the members they actually elect a board to speak on their behalf. And another difference between credit unions and banks is credit union board members, for the most part, it's starting to change a little bit, but the board members are volunteers and they do not get paid. They believe in the true mission and the principle and the founding purpose as to why credit unions were started. And so many board members they do it because they love the credit union and its mission. So it's just a fundamental difference. The profit status is a big deal. It is a contentious topic between credit union executives and credit union trade associations and bank executives and bank trade associations. But really, so as a not-for-profit, we do not pay income taxes. We take all of our profit and the money that we save by not paying taxes, we give that money back to the members. So those members then get higher rates on their savings accounts. They're charged lower rates on their loans, and they pay less or lower fees. And so, therefore, we take our tax savings, give it to the members, and they're the ones that are investing it and building up the community. So, not one better than the other, not one right, not one wrong, fundamentally different. And it's about people for credit unions, where banks really, focus more on the profit side of it than the credit unions do. So we could talk for a long time on this. I
Yeah.
think sometimes what happens is you'll start to see, depending on who you ask, one group throwing the other group under the bus. I don't feel that way. There are a lot of things banks do that credit unions cannot do, and we need banks. And so the more banks, the more credit unions creates more competition. More competition is better for consumers.
Fantastic. No, I love your rendition of that. So thank you for sharing that. I'm going to read a study from McKinsey and Company, this consulting company, just to get your feedback as it refers to younger people and what they think about credit unions. So according to McKinsey and Company Consulting, it appears from their 2023 study, so not too long ago, nearly 6,000 people of nearly 6,000 people, that credit unions are starting to lose a little ground to banks when it comes to millennials, those born from 1981 to 1996. 29% of millennials bank with a bank, while 21% of them bank with a credit union. And then in 2015, 24% of millennials banked with a credit union. So it shows just a little bit of a slide, not a super big decline. But what are your thoughts on how Kemba can do a better job at attracting a younger demographic? What do you think the silver bullet or bullets are to attract that younger demographic to learn more about some advantages of being a credit union member?
Yeah, Todd, I seen that study myself, and I would say if that study looked at fintechs, you'd see a bigger slide. When I go out, I'm speaking to younger adults. What I'm seeing isn't really the big banks anymore. It's more the fintechs. It's the SoFi's, the Chime, um, Apple, Venmo, Zelle, Cash App. Those are the ones I think that the credit unions are losing more ground to those than to banks. I think that what credit unions need to do better job is telling their story. When I started in this industry at Kemba Credit Union 26 years ago, we prided ourselves on being the best kept secret. We truly, honestly pumped up our chests and flexed our muscles and said, we are the best kept secret. And so for a long time, we were a secret. And today we don't want to be a secret anymore. We can't be a secret anymore. Consumers, young people need to know what a credit union is and the value and the benefit of being a credit union. So I think what we need to do is we need to continue to shout loudly from the tallest buildings and who we are, why we're different, how we can help, and just do it one young person at a time. There's no doubt that even at Kemba Credit Union, Todd, our average age has gone up 5 years over the last 10 years. So if you looked back 10 years ago, our average age was 45 years old. Today, we're a little over 49. And so we need to do a better job. We recognize we need to do a better job. And so we are putting a lot of attention behind telling that story to the right audience at the right time.
Yeah. 100% with you on that with the fintech. I get that. Of course, speaking on behalf of Kemba too. Uh, on the flip side, though, McKinsey says that 50% of credit union members perceive membership of credit unions as providing extremely good value. In comparison, only 40%, 46% of bank customers feel that way with their branded bank, and 44% feel that way with a smaller bank. To me, this represents a significant opportunity for credit unions too, because of that value and my thoughts, and tell me yours on the fintech with the cash apps and the Zelle. And I'm like, that's your bank. Like, yeah, you do everything. And they say, yeah, but even though that's, a tech thing, they really end of the day, they go, yeah, I actually missed some guidance from someone. I do kind of miss that walking in or at least talking to somebody when I have an issue. So what are your What are your thoughts on what I just read that credit unions, you're not surprised, of course, almost 60% like the credit union experience. Why do you think when someone joins a credit union, they're like, well, yeah, this is what's your biggest like, once you come in, we're going to show you some love, and why is that so high in your opinion?
Yeah, I mean, credit union's motto is people helping people. We have another motto. We're not for profit. I shared that with you earlier. We're not for charity, but we're for service. And so the service is the brightest star that we all obsess about all the time. So we always put people first, always, and we always will. Not just Kemba. Credit unions always put people first, not profit. And I think that obsessive, compulsive, consistent drive towards serving people um, authentically and genuinely, I think the people see that and they feel that. And you said family earlier, it is cliche because you hear it all the time, family, 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 but we truly are one family. And at a credit union, we are owned by every single person who walks into our lobbies or calls our call center. They own the company versus a bank. You can own a bank, but your chances are you don't bank there, Todd. I've got a 401k, and I know in my 401k I've got banks in there. There's Wells Fargo in there, and there's others in there, and they're great banks. Don't get me wrong. But I don't bank there. So I think that when members walk into a branch or call a branch, they know that they are part of something bigger, and they're drawn to that level of service because that is exactly what credit unions are built on, is just serving people.
With Dan Sutton, CEO of Kemba Credit Union, on the Do Money Differently podcast, brought to you by Acorns. I had a meeting with you recently, and I literally wrote down your quote. I thought it was brilliant. And I actually shared this with some other people. They're like, wow. And this was another credit union that said, I like this. You said, we want to have at Kemba Credit Union, we want to have sincere members, not mere members. Touch on that. I'm going to give you some brilliance there. I thought that quote was
Yeah.
great. What do you mean by having sincere members and not just mere members?
Yeah. So I appreciate that. We want members, we want to be a member's primary financial institution. We want them to think of us, whether it's on a loan side, a savings side, insurance, etc. So my point on that, Todd, was we do a lot of business in auto lending. And a lot of times, many times, we'll get a new member, a new borrower from a dealership. And and we love those members and we love those borrowers, but those members and those borrowers merely became a member because the dealer sent them in our direction. Um, and they stay merely a member because they don't sign up for any other services for us. They leave their checking account somewhere, they leave their credit card somewhere, they leave their mortgage somewhere else. The sincere member comes to us and they recognize the value. They recognize that we have credit cards that they can transfer their balances to. We have mortgages where they can refinance and save money. And so they bring us a bigger share of their wallet. And they look to us to help solve many of their use many of our products to solve many of their financial issues. So just kind of like buying into the credit union philosophy and just kind of stepping in with both feet versus the mere member who may have a toe in our relationship or maybe one foot.
Yeah. I Again, I thought that was brilliant. Makes a ton of sense. And you and I both know a lot of people do get started. Hey, Kemba has a cheaper auto loan. Okay, I'm going to go and be a member for whatever 2 years, and then I'm out. So,
Yeah.
well, we certainly feel strongly with Young Money University and what we're doing with other credit unions besides Kemba. I love working with your organization. It's just fun teaching money, and then they kind of go, wow. And we were just talking before we got on live, right? Uh, Share with what what you're doing as well. Miami University and Oxford, Ohio, for our national listeners and viewers. Miami University, what's a beautiful campus, right? And Kemba, uh, as as of a year or two ago, is now the official bank sponsor, credit union sponsor of athletics for Miami University and also the Alumni Association. Uh, Tell everyone what you were telling me about. You're talking to a lot of young people to help shape and form some of your marketing and just business goals with them. I'd love to hear more about what you're doing. I know our listeners are too.
Yeah, well, I love talking about this. I love talking with young people. I love talking with anybody, to be honest with you. But like I said earlier in the podcast, our average age is 49, and so we have got to figure out a way to bring that back down. Not that we don't love our 49-year-olds, okay? We do, but we need to get younger. And so one way of getting younger is being relevant to the youth. What does a young emerging leader, a young adult, what do they want when they graduate from college? What do they want? And instead of me sitting here as the nearly 54-year-old bald guy guessing what they want, I'm going right to it. I'm going right to the campus, and I'm asking these young, brilliant students, what are you going to expect when you get your big girl job, your big boy job? And I do that all the time. I do that in classrooms. I do that anytime and every time I get an opportunity to get in front of a young student or a classroom, I will. And I promise you, Todd, I walk away there. I learn more from them than they do from me. The other thing we're doing with Miami is their capstone project that their marketing and finance students are going through. Again, going to these 22-year-old smart, energetic kids and asking them, instead of me telling you what you need when you graduate, you tell me what you want. What are you going to need? What's it going to take for Kemba Credit Union to win you over, pry you away from the checking account or the savings account mom and dad signed up for you when you were a teenager? What's it going to take? So you help build and shape the product and the service that you're going to expect, and then we'll listen and hopefully we'll deliver. So going to them versus guessing what they need, just straight up asking them, Todd, what do you need?
So what are you finding out? What's the top two things that they are telling you that they need?
It's kind of funny because like the millennial generation and the Gen X generation, there's a difference there. I used to think they're all the same. They're young, spoiled, whatever. Wants everything right now. And I'm learning that there is a difference.
That whole
Right.
entitled
All
thing,
of
which
that. And
I've always defended them, by the way. Like you, like I was kind of impatient when I was 22 too. I was a little
yep.
entitled in my mind because I was immature, because we're all kind of like that. But anyway, yes, keep.
Yeah. Yeah. No, but what they're saying is, so what I'm hearing now what they're saying and what I'm hearing might be two different things because they're two different generations. But what I'm hearing is, they want us to be there when they need us, not when it's convenient for us, but when it's convenient for them. So if it's 3 o'clock in the morning and they want to jump on their app and they want to move some money around or they want to pay a bill, they don't want to wait until we open the next day at 9 o'clock a.m. So we need to be there when they need us, when it's convenient to them, not when it's convenient for us. So that's one thing. And then they're really big on the social causes. It's cool that we have this product with this rate, but they want to know more about what are we doing for our communities. What's the big? They want to be a part of something bigger. And so continuing to tell our story about how we're different, our focus on service. They want to hear more of that. And then financial literacy. Every single student I ever talk to, including my own 26-year-old daughter, will tell me nobody talks to us enough about finances. Finances stress us out. They freak us out. And we need somebody that we trust who will help us and point us in that direction. And I think that is probably the biggest thing, Todd, is the financial literacy. They want financial help, whether it's budgeting, saving, investing, giving, all the stuff you talk about at Young Mooney University. That's what I'm hearing on the college campuses that I go to. And I'm very, very proud of these kids for at least recognizing and admitting that they don't know. Because I told you when I was 19, I didn't know either. And I blew $4,000 back then.
With you. I love hearing that. What you just said, the admission, really in humanity, it's one of the greatest, highest levels of respect I can give someone is when they say, you know what, I just don't know, or I was wrong, right? Those are the two most powerful things I believe in relationships and life is, okay, I don't know. So I need help, right? I need help. I don't know. there's nothing embarrassing about that, right? We think it is in our mind, like, feeling ashamed or embarrassed because I need help. No, no, no. If you got a problem, everyone loves to help people, right? So number
Right.
two, I was wrong. Yeah, I want to keep moving forward. Please forgive me. So I love what you just said because it's a big deal when someone says I need help, and then they get the answers from you. I will never forget a phone call from you at 7:45 a.m. I am in St. Pete, Florida, about 2 years ago, and you just started this capstone program at Miami University, and you called my cell, which I wasn't anticipating. I'm like, well, this is an early call, and hey, Dan, you're like, hey, I just got back. I'm heading back up to Miami to speak to these capstone students. And Todd, you were right. They really want this stuff that, you were just enthusiastic about our partnership and right back at you. I love working with your organization and credit unions who are just trying to help young people become better financial people, better when their finances are in order. Dan, you know this, then it helps so many different areas of their life, right? So
Right.
I love
Right.
that.
Well, I think they thirst, Todd, for trusted guidance too. There's so much out there, whether it's TikTok, Reddit. There's all kinds of forums out there. But I think that they're smart enough to understand that that's not the sage advice that they really need. They want to go to someone that they trust. And I think that if we can tell our story effectively, because we want to be that sage advisor for them and help them out. So I owe every millennial and Gen Xer an apology because, I was that guy calling them all those. But I've learned over the years that they're just a brilliant generation, and starving for help, and we want to be there to help them.
Yeah. I also learn every time I speak around this country. There is not one moment that I go and say, oh, yeah, I know more than you, people in the audience. I have wonderful interaction from both young ladies and men just about their dreams, too. That's another big thing, right? That we talk about that I tell them all the time. We're, we're a financial success educator. We'll teach you how to do these things, but we are not a bank. We're not a credit union. We don't have, you can't invest money with us to put into the stock market. No, that's not us. This is where your banking relationship, I say, is huge. Your banking relationship is your literal money engine to start doing these things that we teach inside of Do Money Differently, right? How to save money better with creating named savings accounts. Like every young person that I speak to, and I know you do, they want to have a feeling of more control over their money, right?
Yeah.
And so you and I know this is a simple thing, but when I share that you can have a second, third, fourth, fifth plus named savings account with your credit union with only a $5 minimum balance, they go, wait, what? You can have more than one savings account? You and I know that's simple, but it's not common knowledge. And I bet you hear their interest. Do you also hear their interest in investing? You mentioned that a moment ago, how to start investing safely and
Yeah.
securely. You hear that too?
Yeah, matter of fact, that was the last question that was asked to me. Again, 2 days ago on Tuesday, I spoke to this college class, this in this theater. The very last question was this young man, 22 years old, asked me about investing. I think it's a great question, and it's a timely question, right? Because the sooner you get started, the better. Not only do you develop those habits, those disciplines about investing, but you have time. Time is a young person's best friend. Compound interest on top of compound interest on top. So I love the fact that a 22-year-old asked me about investing. I wasn't thinking about investing when I was 22. I promise you that. So I'm really, really proud of these kids when they ask about investing.
Fantastic. All right, we're almost done here. Again, with Dan Sutton, CEO of Kemba Credit Union, based in Cincinnati, Ohio, as part of the Do Money Differently podcast. I saw a recent photo, correct me if I'm wrong, on your LinkedIn a few weeks ago. You were in DC with a
Was.
running club. Is that right? Are
Yeah.
you a runner? Do you like,
Yeah. Yeah.
give
It's
me,
something I started 2 years ago, actually, almost to this day. Uh, Trying to get, well, Todd, it's at the credit union, we have very sedentary jobs. And so I'm just trying to champion my staff to get up and move around a little bit more. And so I challenge my staff to steps. And what a better way of getting steps is to run. So I started running a couple of years ago. And then when I was in Washington, D.C., at that time, I got 2 people to join me to run the mall in the rain. It was pouring down. It was terrible, by the way. My goal was to get one more person. And this year, not only did I get one more, I got actually 3 more. So there were 6 of us running the mall. And so my goal for next year is to grow this little credit union running club to double digits, 10 or 12. And just, like I said, just try to get people out and moving and stay active.
It's fantastic. Love it, man. Again, appreciate you being on the Do Money Differently podcast, brought to you by Acorns, where you can begin investing fractionally with as little as $5 a week or month and begin owning stocks and bonds like Dan and I do and everyone else does. Again, Dan, thank you for being on Do Money Differently. It's been I always learn from you as well. Hearing your experiences out there from when you were young to where you are now. And I love what you said to me also in a recent meeting is that you hire people. This is unrelated to money, but kind of still related to money. You hire people on the person, like where I like that person, male or female, and we'll find something for them. And that's kind of what your philosophy is, which I thought is also really cool too.
Yeah, I'm first who, then what? I have enough confidence in myself that I can teach the person the credit union business, but I can't teach the person to be trustworthy and ethical and all of that. So I'm a first who, then what person.
Love that. We'll end there. Again, Dan, thank you for being on. Do Money Differently. We will talk soon.
All right. Thank you.
Thanks, everybody, for listening to the podcast, Do Money Differently. We'll see you in the next session, episode, and podcast. Have a great week.